I think it's more the latter than the other dynamics. I mean, the company is going through a bit of a product refresh here, and I think some of the discounting reports that were out there around pricing were oversold here, and I think people were digesting some of that. You also see a stock move 20% like this one has, and a company that really is pioneering important technology over the coming decades, and I think folks just look at this and say, time to take a short-term trade on this or cover a short.
Tesla stock, currently trading at $233.19 per share, has dropped several times already during the year. As can be expected, investors didn't take this lightly, but some remained optimistic about the company's future. However, some say the Tesla stock is not done tanking and will probably drop to at least $150 before the year ends. In light of this, bulls pointed to the fact that Tesla stock actually suffered more in the past year compared to now, and this year the stock finally recovered. That said, let's try to understand why Tesla's share price dropped in 2022 and gauge if it's likely to happen this year. Last year, Tesla's share price drop has many causes, not the least of which was the tech market slide shown by the Invesco QQQ ETF, which was down 23% over the last year. Since Tesla was down 66% over that same period, it is safe to say that there were other items affecting Tesla's price. With huge electronics component requirements for its products, Tesla was adversely affected by the various chip shortages. Add to that the logistics problems that plagued the world last year, Tesla may have been hit harder than most. Perhaps the biggest issue, however, lies in Elon Musk's obsession with his Twitter takeover, which dominated the news for almost the entire year last year, but appears to be not as important now. This is viewed as a big advantage for Tesla investors. Now, what has been causing this year's drop? Well, one analyst thinks more price cuts could be on the way for the electric car maker. In April, Tesla shares tanked following the company's release of its first quarter vehicle production and deliveries data. While deliveries grew nicely year over year, it wasn't enough to excite Wall Street. As analysts studied the report, their published viewpoints on the update have been mixed. Some analysts were pleased with the 36% year-over-year growth, but others admitted that the nearly 423,000 deliveries were underwhelming. In light of this, one analyst reiterated an underperform rating for the stock and a $150 12-month price target. And the reason for that is this. Earlier this year, Tesla rolled out major price cuts for its vehicle lineup. This sparked concerns in the media about potential demand softening. But Tesla CEO Elon Musk said in the company's fourth quarter earnings call that the lower prices were driving a significant surge in orders. Eventually, investors ultimately warmed up to the idea of price cuts, evidenced by the stock's soaring price year to date. Further, part of the price cut was essentially giving back price increases that occurred in the prior year, as higher costs led Tesla to raise prices on its vehicles. As some of Tesla's costs started to normalize more recently, it made sense for the company to pass those savings on to customers through reduced prices. After all, lower prices typically drive higher unit sales. However, Bernstein analyst Tony Sacconaghi thinks that there are more price cuts to come. He notes that Tesla's vehicle inventory, while still low, has been growing. Further, the wait time between a new order of a Tesla vehicle in the US and the expected delivery window is currently low on all models except Tesla's Model Y, Sacconaghi says. He thinks that these things point to signs of a tough demand environment and potentially more price increases later this year. With expectations for more price cuts, Bernstein thinks shares are overvalued and offered a 12-month price target of $150 for the stock. Notably, Tesla stock hit $153 in the latter part of April, but since then Tesla stock has soared significantly to its $230 current valuation. Still, investors aren't very optimistic about the stock. In fact, several Wall Street banks downgraded Tesla stock in the past couple of weeks. It started with UBS, who said, "We downgrade to neutral because we think the recent strong share performance fully reflects the strong demand response seen after price cuts, as well as a solid executive in 2024. Immediately after, UBS analyst Patrick Hummel cut his rating on Tesla shares to neutral. After being at buy for the past 13 months, Tesla stock fell 0.5% in the morning trading, putting them on track to suffer a fourth straight decline. Not long after that, two more major Wall Street banks followed suit. Barclays analyst Dan Levy downgraded Tesla shares to equal weight from overweight, claiming the recent rally ignored near-term questions about the stock's fundamentals. Though Tesla doesn't exactly trade on fundamentals, Levy made some interesting points about where Tesla stock sits compared to the month prior. Levy's main thesis for the downgrade rests on three main points: the AI effect that may be overblown, Tesla's recent supercharger deals and uncertain benefits, and most importantly, how multiple expansion is the entirety of the rally. Marking the third Tesla downgrade in July, Morgan Stanley downgraded Tesla to equal weight from overweight with a price target of $250 from $200. "We're not trying to call the end to the Tesla rally," Morgan Stanley analyst Adam Jonas explained. And from our discussions continue to find a significant degree of investor skepticism, lack of exposure around the name. Similarly, Goldman analyst Mark Delaney downgraded Tesla stock to neutral from buy. While the primary reason for the change in our view is that we think the market is now giving the stock more credit for its longer-term opportunities, we are also cognizant of the difficult pricing environment for new vehicles that we think will continue to weigh on Tesla's automotive non-GAAP gross margin this year, Delaney wrote. Then, the DZ Bank, too, downgraded Tesla stock to a sell rating down from its previous buy rating with a $210 price target on Tesla. In addition to that, nearly 20 analysts have downwardly revised their earnings forecast for the company, highlighting short-term risks. Additionally, Tesla's high price-to-earnings ratio, absence of dividend payments, and the stock's volatility are notable negatives. Despite all this, investors should note that there's a good reason for Tesla's inventory build. The company explained in its fourth quarter update that it has been working toward a gradual shift toward a more balanced regional mix of production and deliveries throughout the year. Given Tesla's efforts to better balance and optimize its vehicle shipment process, its inventory of vehicles will likely gradually increase throughout the year. This may result in more price cuts. Still, whether or not Tesla stock will dip to $150 remains to be seen. As can be expected, investors are hoping against hope that this won't happen. Several factors may contribute to Tesla soaring instead of dipping. This includes Elon Musk's belief that Tesla's sales volume may increase due to the expansion of Tesla's product lines. Elon Musk teased in his master plan Part 2 that Tesla would be expanding its lineup to cover all the major forms of terrestrial transport. So, despite what may be a problematic 2023, Tesla's bright future would be hard to deny. And at the current depressed price, this is an opportune time to invest. It is also important to note that some analysts are convinced that Tesla is supposed to be a long-term investment, so if you prefer immediate gains, Tesla may not be for you. In connection to this, Wedbush analyst Dan Ives, a longtime Tesla bull, recently told CNBC that he remains firmly bullish about the company's stock, even though shares have dropped around 16% in August. "I view this more as a sell-off post-quarter worries about China," Ives said. The analyst added he views this as an opportunity, and that Tesla is a table pounder at these levels. The drop in Tesla stock comes after the EV giant reported Q2 profits growing 20% to 91 cents per share, while revenue increased 47% to $24.93 billion. Analysts expected profits to edge up around 4% to 80 cents per share, with revenue totaling $24.22 billion, up 43% compared with last year. Tesla's total gross profit grew 7% to $4.53 billion in the second quarter. Meanwhile, total gross margins came in at 18.2%, down from 19.3% in Q1, and a decline of 682 basis points versus last year. Auto gross margins, excluding regulatory credits and leases, came in at 18.1%, down from 18.3% in Q1. The short-term variances in gross margins and profitability really are minor relative to the long-term picture, Chief Executive Elon Musk told investors during the Q2 earnings call. Subscribe for more.